What if I told you that hitting $100,000 in savings isn't just a nice milestone? It's actually the moment when the entire game of building wealth completely changes. What if I told you that while most people celebrate reaching six figures and then immediately lifestyle inflate their way back to broke, there's a specific psychological and mathematical shift that happens at $100,000 that can accelerate your path to complete financial freedom. Most people think $100,000 is just 10% of a million, so no big deal, right? But here's what might shock you. They're completely wrong about how wealth actually builds, and I'm going to prove it to you today. I've been studying wealth building for years, and I've noticed something that most financial advisors won't talk about because it doesn't involve selling you expensive products. There's a specific inflection point in wealth building that most people completely miss, and once you understand what happens at $100,000, everything about your financial strategy needs to change. I discovered this pattern after analyzing hundreds of people's financial journeys, from those who stayed stuck at middle-class savings levels to those who achieved true financial independence. The difference wasn't their income, their investment knowledge, or even their discipline. It was understanding what $100,000 actually represents and how to leverage it properly. Over the next 20 minutes, I'm going to walk you through exactly why 100K is the real starting line for wealth building, the psychological shifts that happen when you cross this threshold, and the specific strategies that become available to you that simply don't work with smaller amounts. This isn't theory. This is what actually works in the real world. Here's what I see happening everywhere. People work their butts off to save their first $100,000. They sacrifice, they budget, they maybe pick up side hustles. It takes them anywhere from 5 to 15 years depending on their situation. Then they hit that six-figure mark and something terrible happens. They think they've made it and they start spending like they're rich. But that's not actually the real problem. The real problem is that nobody explains to them what $100,000 actually means in the context of building wealth. They treat it like an end goal when it's actually the beginning of a completely different game. Let me give you a few examples of what this looks like. I know a guy who hit 100K in his 401k and immediately bought a Tesla because he felt wealthy. Within 2 years, his net worth was actually lower than when he started because he stopped contributing as much and took on debt for lifestyle inflation. I've seen people reach $100,000 in savings and then decide they can afford a bigger apartment, more expensive vacations, and all the other stuff they'd been denying themselves. They completely miss the fact that 100K isn't about what you can afford to spend. It's about what you can afford to leverage. And here's why the typical advice doesn't work. Most financial advisors tell you to just keep doing what you're doing after you hit 100K. They say put another 15% in your 401k, maybe open a Roth IRA and wait 30 years. That's not wrong, but it's incredibly inefficient. I remember when I first hit $100,000 in savings, I felt proud, like I had accomplished something significant. But I also felt confused because I didn't feel wealthy. I couldn't afford anything dramatically different than before. I was still living in the same apartment, driving the same car, working the same job. What I didn't realize at the time is that $100,000 isn't supposed to make you feel rich. It's supposed to make you powerful. And there's a massive difference between those two things. I used to think wealth building was linear. Like, if it took me 8 years to save $100,000, it would take me another 8 years to get to $200,000 and another 8 to get to $300,000. Then something happened that changed everything. I started actually tracking the math of compound growth, not just reading about it. And I realized that wealth building isn't linear at all. It's exponential. But the exponential part doesn't really kick in until you have enough capital for the compounding to become meaningful. It's like trying to roll a snowball down a hill. When you start, you're basically pushing a tiny ball of snow, and it's exhausting work. Every inch forward requires massive effort. But at some point, that snowball gets big enough that gravity takes over. It starts rolling faster and faster, picking up more snow with every rotation, until eventually it's this massive force moving down the hill almost by itself. $100,000 is when your money finally gets heavy enough for financial gravity to take effect. But here's an even better way to think about it. Imagine you're trying to light a fire. You can rub 2 sticks together for hours and get nothing but smoke and frustration. But once you get that first flame, everything changes. That tiny flame can ignite kindling, which can ignite larger wood, which can become a roaring fire that sustains itself. Your first $100,000 is that initial flame. It's not the fire itself, it's what allows the fire to actually start. Once you see it this way, everything starts to make sense. You stop thinking about 100K as money you have and start thinking about it as a tool that can generate more money. So here's what I started doing instead of just continuing to save linearly. I began treating my $100,000 as a wealth-generating machine rather than just a safety net. Let me break this down into the core components that make 100K special. First, you finally have enough capital for compound interest to generate meaningful amounts. 8% of $10,000 is $800 per year, barely noticeable. But 8% of $100,000 is $8,000 per year. That's $6,067 every single month that your money earns without you working for it. Suddenly, compound interest isn't just a concept, it's paying your rent. Second, you qualify for investment opportunities that simply aren't available to smaller investors. Private REITs, certain bond funds, dividend aristocrats that require minimum investments, doors start opening that were closed before. Third, and this is huge, you can start taking calculated risks that have asymmetric upside. When you only have $20,000 saved, you can't afford to lose any of it. But when you have $100,000, you can potentially put 10 to 20% into higher risk, higher reward investments while still maintaining a solid foundation. Now you might be thinking, wait, isn't this exactly what people mean when they say the rich get richer? And honestly, yes, that's exactly what this is. The financial system is designed to reward people who already have capital. Once you understand this, instead of fighting it, you can use it to your advantage. The key is recognizing that $100,000 gives you 3 distinct advantages: meaningful compound growth, access to better investment vehicles, and the ability to take smart risks. Most people only focus on the first one and miss the other 2 entirely. But here's where it gets really interesting, and this is something that most financial experts either don't know or won't tell you. Most people stop at the basics, but there are actually 3 levels to maximizing your first 100K. Level 1 is what everyone talks about. Just keep investing consistently and let compound interest do its work. This is fine, but it's slow. Level 2 is where you start diversifying beyond traditional investments. Maybe you put $10,000 into REITs for monthly cash flow. Maybe you invest in dividend-paying stocks that generate quarterly income. Maybe you explore peer-to-peer lending or high-yield CDs. The goal isn't necessarily higher returns, it's creating multiple income streams that can accelerate your savings rate. Level 3 is where most people are too scared to go, but it's where the real acceleration happens. This is where you use your $100,000 foundation to access leverage responsibly. I'm not talking about day trading or cryptocurrency speculation. I'm talking about things like real estate investment, where you can use your capital as a down payment to control assets worth much more than your initial investment. Here's something I wish someone had told me earlier. Once you have $100,000, your biggest risk isn't losing money in investments. Your biggest risk is inflation slowly eroding your purchasing power while you play it too safe. I learned this lesson when I met a guy who had been saving conservatively for 20 years. He was proud of his $200,000 in savings accounts and CDs. But when we calculated the real purchasing power of his money after inflation, he had essentially been treading water for 2 decades. He had the discipline to save, but he didn't understand that money sitting still is actually moving backwards. This is why the 100K threshold is so critical. It's not just about having money, it's about having enough money to stay ahead of inflation while still generating meaningful growth. Another thing most people miss, once you hit 100K, your tax strategy needs to completely change. You can't just throw money into a 401k and call it a day. You need to start thinking about tax loss harvesting, Roth conversions, asset location strategies, all these techniques that only make sense when you have substantial assets to work with. The people who truly understand wealth building use their first 100K as a stepping stone to financial independence, not a security blanket to make them feel safe. Now, implementing this isn't just about technique, it's about becoming a different kind of person. Someone who thinks like an investor rather than a saver. Here's what I mean by that. Savers think about money in terms of security and protection. They want to minimize risk and preserve what they have. Investors think about money in terms of opportunity and growth. They want to maximize returns and create more wealth. Both mindsets serve a purpose, but they're appropriate at different stages. When you have $5,000 in savings, thinking like a saver makes sense. You need that emergency fund, you can't afford to lose it, and your primary goal is building a foundation. But when you have $100,000, continuing to think like a saver is actually counterproductive. You need to shift into investor mode, which means accepting that some volatility is the price you pay for growth. This connects to something much bigger than just personal finance. It's about how you see yourself in relationship to money and opportunity. Most people have been conditioned to think that money is scarce and that wealthy people got lucky or did something unethical. But when you have $100,000 working for you, you start to understand that money is actually abundant for people who know how to create and multiply it. You begin to see investment opportunities everywhere. You start noticing businesses that could use capital. You pay attention to market trends and economic cycles. You develop what I call wealth vision, the ability to spot opportunities that other people miss because they're not thinking like investors. This shift in perspective is honestly more valuable than the money itself, because even if something happened to your $100,000, you now have the knowledge and mindset to build it back, probably faster than the first time. All right, so how do you actually implement this starting today if you're at or near the 100K mark? Here's exactly what I recommend, and this is based on years of testing different approaches. Step 1. Separate your $100,000 mentally into 3 buckets. 60K stays in conservative investments, index funds, bonds, things that will reliably grow but won't keep you up at night. This is your foundation. Step 2. 30K goes into what I call opportunity investments. This might be REITs, dividend stocks, peer-to-peer lending, or other investments that can generate regular cash flow. The goal isn't necessarily higher returns, it's creating multiple income streams that can accelerate your savings rate. Step 3, 10K becomes your education fund. This is money you're prepared to lose while you learn about higher returns investments. Maybe you try individual stock picking. Maybe you invest in a rental property. Maybe you fund a side business. The point isn't necessarily to make money immediately, it's to gain experience with different types of investments while the stakes are relatively low. Now, you're probably going to run into some challenges with this approach. The biggest one is emotional. When you see that 10K education fund lose value, and it probably will at some point, your natural instinct will be to panic and retreat back to 100% safe investments. When this happened to me with my first real estate investment, I lost about $3,000 in the first year due to unexpected repairs and vacancy periods. My immediate reaction was to think I was terrible at real estate and should stick to index funds. But then I realized that $3,000 was the cost of education that would serve me for decades. That experience taught me about property management, tenant screening, cash flow analysis, and market cycles. Knowledge that I used to make much better investments going forward. The second challenge is information overload. Once you start researching different investment options, you'll find a million experts with a million different opinions. Some will tell you real estate is the only way to build wealth. Others will insist that stock index funds are the only rational choice. Others will push cryptocurrency or commodities or forex trading. Here's what I learned. The specific investment vehicle matters less than understanding the principles of risk, return, liquidity, and diversification. Don't get caught up in finding the perfect investment. Instead, focus on building a portfolio that balances growth potential with downside protection. The third challenge is timing. You'll constantly wonder if you're investing at the right time. Should you wait for a market crash? Should you invest everything immediately? Should you dollar cost average over time? The truth is, nobody can time markets consistently. The best time to start investing your 100K strategically was yesterday. The second best time is today. So, what does success actually look like at different stages when you implement this approach? In the first year, you might not see dramatic results. Your portfolio will fluctuate, you'll learn some expensive lessons, and you might question whether this approach is working. This is normal and expected. By year 3, you should start seeing your money working noticeably harder. Your dividend payments and interest income will be covering some of your monthly expenses. Your total net worth will be growing faster than it did when you were just saving linearly. By year 5, if you've done this correctly, you should have somewhere between 200 and 300K in total assets. More importantly, you'll have multiple income streams, experience with different types of investments, and the confidence that comes from seeing your strategy work in real time. By year 10, you're looking at potential financial independence, not because you saved every penny for a decade, but because you learned how to make your money work as hard as you do. But here's what's really transformational about this approach. It changes your relationship with work and money fundamentally. When you know your investments are generating meaningful income, you stop feeling desperate about your job. You can negotiate from a position of strength. You can take calculated career risks because you have a financial foundation. I remember the first month when my investment income exceeded $1,000. It wasn't life-changing money, but it was proof of concept. It showed me that passive income wasn't just something rich people talked about. It was something I could build systematically. That psychological shift from I need to work to pay my bills to I choose to work because I enjoy creating value is worth more than any specific dollar amount. It affects how you show up in your relationships, your health, your sense of purpose, and your overall satisfaction with life. Here's my challenge to you. Stop treating $100,000 like it's just a bigger emergency fund and start treating it like the wealth-building tool it actually is. If you're not at 100K yet, focus everything on reaching that threshold as quickly as possible. Not so you can feel rich, but so you can start playing a completely different game. If you're already there, stop playing it safe with money that could be working much harder for you. Take that foundation and build something that can actually change your life. The difference between people who stay stuck at middle-class savings levels and those who achieve real financial independence isn't luck or intelligence. It's understanding that $100,000 is where wealth building actually begins, not where it ends. Make sure to subscribe if this changed how you think about building wealth, and let me know in the comments if you've experienced this shift yourself. Your future self is counting on the decisions you make today. Make them count.